bring in Ross Greenwood. So there's a bit to circle around here. We'll start with Bitcoin. We've watched this for a few days.
Well, let's have a look at it and just see what's happened overnight, because the falls that we've seen subsequent to Kevin Warsh being appointed as the new chair of the Federal Reserve has just accelerated overnight. So these are live prices coming through on Bitcoin right now, $64,000. Remember that Bitcoin prices peaked at $126,000 last year. So they have more than halved from that point. Now, here's Bitcoin over the past year. You can see where those peaks were late last year, but now the valleys are right there. $63,800, give or take, jumping around the place. Bitcoin prices down by 27% in the past year. And the reason for this is really that investors right now are basically going away from the theory that they didn't need US Treasuries, that basically now they're actually going and dumping their gold holdings, they're dumping Bitcoin as alternatives to the US dollar, and they're going back to the US dollar. So that's the interesting thing about this. It's kind of curious. Strangely enough, the Aussie dollar is actually hanging in there at the moment, 69.36 US cents. But the reason for that is largely because of our interest rates going up, but in the United States, interest rates are expected to keep on falling.
Is Bitcoin becoming a bargain, Ross?
Well, it probably is, but it depends on this new chair of the Federal Reserve and just what he does. If he follows through with his actions, and really that is to print less money. They have the Fed printing less money and also then concentrating and focusing on lower interest rates in the United States, then the answer is probably the fall continues until that sentiment starts to change.
Okay, let's get to this merger collapse. What's happened?
So this is big because this is all about copper, right? So copper is the hot material of the world right now, and the copper price has driven enormous mining deals. So you had BHP trying to take over the South African miner. Now you've had Glencore and Rio trying to get together. Rio, the bigger partner here. But overnight, the two companies have simply said, we can't do this. Glencore here in Australia owns the Mount Isa operations. Rio Tinto, of course, has got giant iron ore operations. They've both in the past had coal operations they've largely tried to get out of. As a result of this merger being called off overnight, these are on the London stock market. Glencore shares down by 7%. Rio Tinto shares, which are listed in Australia, but also in London. So these are London prices down 2.6%, and you can almost expect that that will be replicated when our market opens in a couple of hours'
Well,
time.
speaking of red arrows, tech shares. As this follows Jeff Bezos and his attempts to basically shed the workforce of the Washington Post.
Well, there was 12,000 jobs, right? So 12,000 jobs they're going to shed. And this is about AI. This is about the fact that in many cases, investors are now starting to catch up with the idea that maybe these companies are overcapitalising in AI, the data centres, the power sources, all these things. So this is what three of the big AI-related stocks have done overnight. On the main Dow Jones index. So Amazon down 4.2%, Microsoft down the best part of 5%, Salesforce about the same. So this is about concerns that in every one of these cases, these companies is overcapitalising the AI investment and it won't pay off. But again, to your point, is this a buying opportunity or is this actually a time when you've got to take some care? Now, at the moment, you probably take a bit of care. But there's one other thing in the back of my mind always. With our dollar hovering around 70 US cents, when it's been down at, as far as 59 US cents in the past year, you wonder whether this is a little opportunity for Australian investors maybe to get set in some of these stocks. You might have to wait a little while, wait until really the floor is hit with some of these companies, but you know they are going to be the future, that they are going to be around the place in 10 or 20 years' time.
Let's get to capital gains tax and the discounts there. It seems as though the government has got its eyes on this.
Well, absolutely. And they always have. It's been Labor policy, let's be honest. Change negative gearing, change capital gains tax. So now what they're doing is they need the money, so they're going to start to attack the capital gains tax. And the answer is, well, it only affects those people who have made a whole bunch of money. This is how the deal works at the moment. So you just explain it. You've got to hold your assets. Let's say, for example, you've bought some shares or an investment property. You must hold it for 1 year. And then after that, you get a discount. Now, if you sell your asset, let's say you make, 100 grand. So what happens is you take that $100,000 profit, you theoretically cut it in half, makes it $50,000.
And then you're taxed on that amount.
And then what you do is you add that to your income that year. And then whatever tax rate you come up with, the profit, the $50,000, let's say, is basically taxed at that rate. Now,
the discounted rate.
The discounted rate. So that's it. So what basically Treasury's put the theory out there over the years, and also Labor Party politicians have said this is what comes. is they want to actually sit there and say the discount shouldn't be 50%, it should be 25% or 30% or 20%.
Yeah.
So whatever it is, that's what they will do. But the issue here is that as a result, the government would collect more money. So big tick for the government that's got budget problems.
Yeah, more taxes.
Right. So it's not about the government wanting to cut its own spending. It's wanting to collect more money from taxpayers. But the problem is there could be greater fairness implied by that tax rate. In other words, investors don't get a big break, but investors will be tempted to hold their assets for longer. And the reason is because you only pay capital gains tax when you sell.
Yeah.
So therefore, as a result, housing investors, they would not necessarily be tempted to sell their homes. And as a result, the supply of housing would become tighter. So it wouldn't have the effect.
So that's another dead end.
Correct. So this is the whole point. So all of a sudden, what would that do? Squeeze up the price of houses.
Yes.
And that's what you don't want to do at a time when you've got real pressure on home prices.
Can I just complicate that a little further? I know we're out of time, but if they want to change it, and Phil Curry's got this piece in the AFR today where they might not even have that 50% or 33%. It might just be in line with inflation.
Right.
3.8% or something.
And that's what it's always been. Historically, there's always that calculation, but because inflation's now higher...
So is that a bigger cut? That would be a bigger cut?
No. It's already there as an alternative. So they might simply scrap the whole discounting totally, is what Phil Curry's saying, and simply go back to the old inflation days. So depending on how long you hold the asset, you would only be basically taxed on the gains that you make that are above inflation. That'd be interesting because it depends. If you make 100% on your asset and inflation's only 3%, you're obviously paying most of that away in tax. But if your assets only go up by 5 or 6%, all right, per annum, and inflation's sitting at 3 or 4, then it's not such a big tax. And this is the thing that I think a lot of accountants right now will be discussing with their clients.
I need a whiteboard.
Yeah, that's why I tried to do it there.
I need some figures and just to simplify all that for me. But anyway, there you go. Interesting stuff. Thank you, Ross.
Thanks.
Thank you soon.